So I want to start with you, and I want to stay on this rate story. I think it's the story of the market, clearly. And you got caught the wrong way in a trade that you had, which you are now out of. Tell us.
Yeah, TBT, which is the ultra, which means that it's doubling the size of the position, using leverage essentially. And I was betting on short treasuries, specifically around the 20-year. Didn't work out. As you may recall, when I went into the trade, I said, look, I think yields are around 150, 1.5, 1.55. I said, look, my downside's 1.4, and my upside in terms of rates, which means bonds would, of course, decline for rates to go higher, for yields to go higher, was about 2% by the end of the year. And when it got to 1.4, I said, okay, I'm there, I can hold it. But then it started trading down more, and particularly being in these these leveraged ETFs, which I never do, but did here because the moves in treasuries so minuscule. You get caught. You can't catch up. So I can't tell you that I specifically understand why yields are where they are. I can't tell you anybody's got a good reason. So when I don't know what's going on, I tend to sit back, get out of the trade, and examine it, and I don't mind coming back in, and that's what I'll do here. And in fact, the world could change completely at 2:01 because we get FOMC minutes at 2 o'clock, and if they have even a more hawkish dialogue than we heard in the press conference, I think you'll see the reversal in yields.
You know, Joe, I talked to somebody, a big investor earlier today on this issue of what's the deal with rates? Why do they keep moving lower? The market, as Steve said, seems to be confused what to make of that move. This person told me straight up, just too much liquidity in the system. It's about nothing else than that. It's not about peak growth, because if you look, let's just say, for argument's sake, at inventories, which are at a 5-year low, there's going to be a massive ramp on inventories into the fourth quarter. You're going to have a big economic boom still to come because of that drop in inventories. Don't make too much of it. Straight, simple. Long stocks, short rates. You're going to have a boom. It's all about liquidity and nothing else. Keep it simple.
And I don't have to worry about inflation in that conversation as well, I guess. But I think Steve is indicative.
That was part of the conversation too. And that the market doesn't care about any of that in the future. It cares about the here and now.
Correct. And I also think in that conversation, we're still short 6.7 million jobs from the pandemic. And the question has to be, will you get all of those jobs back? And I'm not sure that you will. But I think, Scott, Steve is indicative of the entire positioning collectively for fixed income. Find me someone who really believed that rates were going to fall to 1.30 and didn't think rates were going to skyrocket above 1.7 towards 2%. So I think a lot of this is about positioning. I agree with you. I think a lot of this is about liquidity. And I think overall, this is just a return to where the economy really is centered. This economy is an intangible asset economy. It's fixated on growth. Growth is 40% of the S&P 500. That's never going to change. And to think that you should be moving away from these growth businesses is foolish. And I think that's what a lot of institutional money has done. The evidence is there in the data to support it. Institutional flows in the month of April and May took positioning to mega cap technology and reduced it below benchmark. And now with rates moving lower aggressively since June 17th, they're raising those allocations once again. And I think that's the right strategy.
Let's just say, Jenny, that view is correct, that this is about nothing but excess liquidity. And that's a bullish sign because the liquidity is not going anywhere in the very near future. The economy hasn't peaked. I gave you the stat on inventories. We're still yet to fully ramp and fully get out this summer and all of that. You believe that view?
I do, but you made a really key point, which is the liquidity isn't going anywhere in the very near term. But the liquidity is going somewhere in the longer term. And what we know from a couple weeks ago from the Fed meeting was that they started to talk about raising interest rates. We all know that that was their way of paving the road to talking about tapering. And the collective wisdom right now is that tapering will probably start in November, December, maybe January.